to another episode of Ask ProVisor. My name is James Mercado. I'm the president of ProVisor, and we are blessed today to have Richie Bauman with us, one of the top loan officers in the country, and a really, really smart LO. So a lot of people say, why are you guys doing Ask ProVisor? We're trying to create value for our referral partners, for real estate agents, for professionals in the industry. So when you're out in the field, you have the ability to inform your clients on sometimes kind of tough subjects.
Mm-hmm.
So we're bringing up some tough subjects to try to make everybody better. Right, Richie?
That's what we tried.
So today, what are we talking about today, Richie?
We are talking about condos.
Oh, the dreaded condo questionnaires, right?
Yes. So I thought, as I talk to real estate agents or we're doing loans, every lender, if there's a loan involved, has to send a questionnaire out to this condo association.
Okay, so hang on a second. So for those of maybe we have some new real estate agents.
Okay.
I'm a little confused. What's a questionnaire for a condo?
Gotcha.
Like, why do you even need a questionnaire? What is a condo questionnaire?
So here's a sample.
We all hate them, for the record, everybody. So
here's a sample of a questionnaire. You should be able to get it from a loan officer so you can actually look in detail. Fannie Mae, Freddie Mac, FHA, they want to know about the condo association.
Okay.
Because when a loan gets done, people are understanding that, hey, there's a financial obligation by the borrower. We need to check them out to make sure they're going to pay the debt. Well, all the loan types also say we need to understand some stuff about the condo association, because the last thing everybody wants to have happen is that the condo association is not run well. The condo association goes through a bankruptcy and now everybody in there gets blown up, even though they can pay their individual mortgage on time. So they want to know about the financial stability of the condo association, the makeup of the condo association, which we'll get into as we go through. So that's why they're getting asked.
Okay, so you have basically a parcel, a building, and so I own part of the building, and you might own part of the building, someone else owns part of the building, but there's a greater building in condominium land, or there's also single family homes that are part of condominiums,
Yes.
But they have shared interest in common areas and things like that. So there's a big bank involved that says, hey, we kind of own this and we're going to sell you part of it.
Yep.
And that's what the reason they want to dig in. And to do that, there's this questionnaire that they have. Almost all lenders have the same question.
Yeah,
right?
this one's right around Fannie Mae.
Okay.
FHA has their own.
So everybody's got their standard questions, but they're all fairly similar for what they're trying to understand before they're going to lend money on a fraction of this project.
Yes. Yeah.
Okay, great. So speak to me a little bit. So what are some of the top things that are answers to the questionnaire that affect a conventional loan?
I know we're live, but I'm going to interrupt you and say we forgot to do the why they care.
Oh, yeah. No. Go ahead. I told you he's super smart. I'm just honored to be here with
He
the guy.
jumped ahead a little fast.
Yep.
So here's the heart of why we're doing this.
Yes.
For you, be the listing agent a minute. Have you ever gone through the accepted offer for a condo, and then all of a sudden the lender comes back and say, sorry, there's too many units that are rental units in the property, a loan can't be done. And now you got to put it back on the market. Well, we're trying to provide some basic information that when you take a listing, you could go to the condo association and go, hey, tell me about these things. And you could put them in the notes for the listing. So now everybody knows what is possible in this condo.
So what happens if, let's say, one person owns a large chunk of the condos?
That's going to be a problem, which
Okay.
We'll talk about.
Okay.
In some loan types.
All right. Is that the same if like the developer still owns most of the condos?
That is a problem too.
Okay, great.
So you as a listing agent, if you get this condo questionnaire from a lender you work with, fill it out. So now you know all the answers and you can be accepting offers that really make sense and not have to worry during the process.
So what you're suggesting is do a little bit more work up front so you have a lot less problems later.
Right.
Okay.
And if you're a buyer agent, this hopefully helps you that when you have a customer who wants to make an offer in a condo association, go to the association and ask a few questions to make sure your offer is going to have a chance, the loan's going to have a chance of going through to completion and not have to find out about it halfway through the transaction process, which everybody hates when that gets a problem.
So you don't have to talk about this now, but I just want to make sure we're going to talk about this.
Yeah.
So a lot of realtors don't understand this, but there's a buzz question that a lot of lenders say, hey, is this a warrantable condo association or is it non-warrantable? Are you talking about that today?
We are talking about that today.
Okay, great.
Yeah.
Awesome.
Okay, so now let's talk. Now go.
All right. So what are the top things that answers to the questionnaire that affect a conventional loan.
Okay, so first loan type, conventional, Fannie Mae, Freddie Mac. There are some nuances between the two, and I'm just going to give you the top things. Like this questionnaire, you can see is 5 pages long. We're not covering all 5 pages.
Yeah.
So here's some of the top things. Condo dues. The condo association has to be contributing 10% of the condo dues to a reserve account that is used for future repairs and stuff like that. And that line item has to be in the budget.
Okay.
Otherwise, how are they going to pay for future problems if they're not contributing to that account? And it does not matter if the condo association has $50 million in this reserve account, they still have to be contributing.
Okay.
Unless on a Freddie Mac conventional loan, the borrower makes more than a 10% down payment, then we're good. They don't have to be contributing. So
All
that
right.
is the one loophole, for lack of a better word.
Okay.
But that's, happens more often than people think. I had a transaction in Dane County, 5 condos in a row were not contributing to a reserve account.
Wow.
And I had the buyer agent asking up front so that we didn't get into it. And then none of them were doing it.
And can the association go ahead and change that?
They can.
Okay.
They just got to put it in their budget.
Yep.
And I don't know these associations, were they violating bylaws by not doing it? I have no idea on that part. But we need to see it on the current budget that they are contributing.
We meaning a lender, not
A lender.
advisor.
Yeah, any lender needs to know that answer.
Okay,
Yes.
that's good to know.
Second one that is comes up is condo dues. We got to ask if the people are delinquent in paying them. If 15% or more of the condo units are delinquent, 60 days or more from paying their condo dues, that's a problem for the loan process.
Oh, wow.
And we're not talking, we're talking everybody in the unit to make, everybody in the association to make the complex for the 15%.
Okay.
We're not just talking the neighbor. We're not just talking, 2 units. Like we take, if it's a quick math, if it's 10 units in the condo association, if 2 are delinquent, that's a problem.
That's a huge problem. Right?
We could probably work through it, get them caught up, but the association's going to answer on this questionnaire how many are delinquent.
Okay, that's good to know.
And then there's been a lot of, when you talk to your condo association, you're going to want to know if the phasing of the condo associations are complete.
So they build, so let's say there's this huge project, right? But right now, phase 1 is done.
Yep.
Phase 2 is in process, and phase 3, they have no idea what's going on yet, but it's in the whole documentation that there's going to be a phase 3 and a phase 2 and a phase 1. Speak to that.
If a person wants to buy a condo in the first phase where all the units are completed, they don't have to be sold, but they have to be completed.
Okay.
Traditional loan types can be used.
Okay.
Phase 2, that's where we're going to get to this thing we're going to talk about is non-warrantable later because
Okay.
they're not complete.
Okay.
But that phase to do a conventional loan has to be complete, and then we're good.
Is part of the concerns, Richie, when like phase 2 isn't complete. So let's just say, we're lending the money and John and Jane Doe are buying a condo in phase 2, but the builder runs out of cash and goes bankrupt. Now you got a half-built project, which happened a lot in 2008.
Yes.
Is that what this is about?
That's what this is about.
Okay.
Imagine, would you ever suggest to a homeowner to buy a house that's half completed and nobody has a plan of finishing it? No.
So that'd not be wise. And that's really what a condo.
That's
right. That
that's
makes
what's
sense.
going on.
Okay.
Yeah.
Do they look at the meeting notes for condos?
They do.
Okay. Talk to me about that.
So this was new. We did an Ask ProVisor. Gosh, what was that? Our third one, I think. It's on our YouTube channel. We had a company, a nationwide company, come in and talk about what they look at when a condo analytics company looks at documents for lenders. Okay. And in there, they talked about repairs. So remember, it was several years ago, down in Florida, the condo fell.
Right. Yeah.
Okay.
Yeah.
That was kind of the impetus for this new standard to start, where as a lender, we have to know what the repair history's been on the condo association.
Okay.
And that can be fulfilled through meeting notes going backwards several months to know if they have been talking about maintenance they're supposed to have been doing that affects the safety of the condo association.
Okay. So just to clarify, about a year ago, I think it was, go to our YouTube channel. We brought in an expert, a nationwide expert. I don't remember where he was out of, but we talked to him specifically about the legal stuff of condos. It was fascinating. It was super interesting. Please go to our YouTube channel and watch that.
Yeah. So the heart of why we have to ask is somebody buying a condo where they have neglected maintenance and it's about to fall apart?
That's a serious issue, which kind of leads me to the next question I have for you. What happens if I'm a disgruntled condo owner and I'm suing the association? How does that affect anything?
There's a question on here to ask about litigation.
Okay.
To go into like all the things of like, well, is it the home? Is it a condo owner? Is it the developer? Is it something outside the condo association? Okay. That could go on and on and on. Yeah, and I can't say I can speak to all that, but you need to know as a real estate agent, ask the condo association, is there current ongoing litigation for the association?
Because if somebody's suing the developer, that could be a huge problem, right?
Huge problem. I actually tried to do a refinance for a condo 4 years ago.
Okay.
Couldn't do the refinance because there was legal litigation between the association and the developer who still had phases to complete. And so nobody could get a loan in that condo complex.
Well, I mean, it's very simple. If the developer who's building these condos isn't paying his subcontractors and he owes the flooring company $3 million.
Yeah.
And that guy's like, pay me or I'm suing you. And now we got a problem.
We got a problem.
All
yeah.
Right.
So those are the top 5. So in recap, to know for a conventional loan, dues being contributed,
yep.
15% or more delinquent,
yep.
Are phases completed, meeting notes for repair maintenance, and no litigation. If you ask those 5 things, you have covered the big ones that are most often seen that cause a problem.
That will diffuse a lot more problems later.
Yes.
Okay, that's on a conventional loan. I want to switch gears to an FHA loan. You know, I know everyone out there loves FHA loans, all right? So what are some of the top things that we need to be concerned about that affect an FHA loan, Richie?
A lot of realtors I talk to are aware of this first part, and that is there is an FHA approved condo list the FHA provides. That means the condo association has applied to the FHA, and the FHA has checked all the documents, and they say, we're okay with doing an FHA loan in this complex. We still have to do a questionnaire, even though they're approved.
Okay.
And we're going to talk about the nuances of that.
Okay.
But that is the first step. And we're going to talk about here later, I think there's a single unit process for an FHA. We'll talk about the nuances of that.
That's called a spot approval, right?
Yeah, spot approval, if the lender uses the nickname for it. Yeah. Okay. So now what is in the questionnaire?
Yes.
Little different. We still have the 15% past due. That is the same as conventional. But a different one is the FHA cares about how many units in the whole association are owned by an owner occupant or they're a rental.
Got it.
And 51% or more have to be owner occupied.
Okay. That's a huge number. If you think about it.
It is. I think it's a lot of grace. 49% can be rentals.
Yeah.
But the heart of it is this a place where people live and own, or is this really an apartment complex?
Got it.
That's why they kind of do it. And they don't.
A lot of times people buy condo and then they
rent it out.
Decide they want to get a house because they got pregnant with triplets and now they need more space.
Yep.
So they got 17 dogs or whatever.
Yeah.
So they rent it out. They don't want the FHA is concerned about that because if you live there and you own it, you usually take better care of it.
Right.
Okay.
So an association usually knows that answer because they usually track how many are owner occupied and not.
What is it? Does the FHA care about specific owners owning any specific amount of units?
They do.
Okay.
So an individual person, like let's say myself, cannot own more than 10% of the units in the association. So again, if it's a 20 unit condo complex, I can use 2. I can own 2 and we're good.
So if it's a 12 unit
and I own 2,
you own 2,
that's a problem.
Can't do it.
Nope. The FHA says no. They like what I think what they're trying to prevent is a developer owns 5 of the 12.
Sure.
And it's not really been transferred over. I actually had one in Madison in 2008 when all that happened. A developer came in and saved a condo association by buying a ton of the units.
Okay.
And it saved the association. But now that was a problem with the FHA loan because he owned way more than 10% of the units in the complex.
Okay. Would you like, and I know this is more of an op-ed right here, but would you like to comment on why that's a problem?
Because if the developer if one person owns too many, they start to control the situation.
Yeah.
When they go to vote, and it's kind of, think about if the person owned 90% of them. Well, that's really my apartment complex.
Right. Yeah. Okay.
And so, yeah, they just,
or if the guy goes bankrupt and loses everything,
That's
you
true.
could destroy the whole project.
Destroy the whole project.
Yeah. Okay.
So then,
And that happens quite easily. Like, let me give you an example. So I have a friend of mine who bought a condo for his parents years ago. Okay. And then all of a sudden another condo went up for sale, was going to go for sale. And they were talking to his parents, and his aunt wanted to move in there. So he bought that condo for his aunt. All right. Well, now all of a sudden it was an 11, I think it was 11 or 12 units in the project. He owns the one that his parents live in. He owns the one that his aunt owns in. So that's going to be a deal breaker on FHA loans. And he's just trying to help people.
he's just trying to help people.
And he's an investor, obviously.
Right.
But
And why, we obviously haven't talked to the FHA, like, why do they really care? But we're giving interjection of what the perception is and again, the FHA, the borrower, the buyer is asking the FHA to insure that loan for performance.
yes.
And the condo association makeup can affect the performance of the association, which can trickle down to the individual units.
Bottom line is you got a bunch of really smart kids that are actuaries that are running the numbers on a national level saying, this is the statistical data that showed we have higher default rates in the average. It's like, okay, then that's our rule.
That's their rule.
Got it. Okay.
They have the same thing about litigation.
Okay.
You got to ask about litigation going on in a condo association.
What about insurance for the FHA?
So on the FHA, not conventional, like, they got to have a master liability policy for unconventional. We didn't talk about it, but that's usually not a hurdle.
Yeah.
But the FHA cares a little more what's in that insurance.
Okay.
They have a standard that the property insurance has to be 100% replacement cost of the project, the whole condo association.
Okay.
They care about the deductible. Max is 5%. And I even had one insurance policy where the association did not have a line item that protected the association from employee theft of condo money.
I mean, like if the treasurer's embezzling money?
Embezzling money.
Which happens, unfortunately.
Right. But the FHA wants to know that the part of the master liability policy, which is the policy that covers the whole association.
Mm-hmm.
Remember, I don't think we defined it. Master liability policy, the association insures, I always say, from the 2x4s out.
Yes.
The common areas and 2x4s out of the building. The homeowner, the condo owner, is going to be insuring the drywall in. We're not talking about the drywall in policy. We're talking about the association policy. Okay. And so that's why they want to know that if employees going to steal all the condo's money, association money, there's got to be money there put back somehow.
Let me give a little tangent. So we had a client who was buying a condo in the southeastern Wisconsin. And the real estate agent was a newer agent, didn't understand this. Oh, there's a master liability policy, you're good. So the client didn't get the contents policy for the condo. The neighbor below them had a house fire, burned the whole thing down. They lost everything and they had no insurance. So everything from the studs in, they lost all, they had no insurance.
Yeah.
Nothing. So the master liability covers basically the structure from the outside out, but remind your client that they have to have a policy to cover the sheetrock, the cabinets, the flooring, the appliances. It's like a renter's policy is basically what it is.
Yeah. And, going back to conventional loans a minute on this master liability, I know I didn't read that as one of the things that are a big deal, but if you're representing a buyer, my personal opinion, you want to check out that a proper master liability policy is there.
Yeah.
Because like you just said, the building burns down, the condo individual owner, he's just getting money for the drywall in. Does the association have the ability to rebuild the whole building? Yeah. That's what a master liability policy has to do.
And this client looked at the realtor and said, you didn't tell me that.
Yeah.
And the realtor, it was a really awkward situation and lawyers get involved and all that kind of stuff because she lost every single thing. And, her parents gave her the money to pay cash for this.
Yep.
So, she was newly divorced and it was a mess. It was honestly a mess.
We have people who another tangent on just people buying houses. You buy for cash. You don't need to have home insurance.
Right.
And people do this. I'm shocked when I find out that they're doing it. I'm like, okay, that's their ability to do that if they want, but that's
completely irresponsible though.
So those are the top things with the FHA.
Okay.
51% or more must be owner occupied. 15% or less past due on condo dues.
Okay.
One person can't own more than 10% of the units. No litigation. And master liability policy has the unique things about deductible and replacement and employee theft.
All right. Once again, you're watching Ask ProVisor. My name is James Mercado. I have with us Richie Bauman, and today's topic is we're talking about condos. We're looking at it from a conventional loan perspective, from an FHA loan perspective. We're about to get into the other types of loans like a VA and a USDA here in a second. But if you have any questions, please feel free to email us. We answer live questions right here on the hour. This is a live broadcast right now. So, and if you know somebody who would benefit from watching this, send them to our YouTube channel. We'll have this up on YouTube this afternoon. Okay. Richie, talk to us a little about VA loans.
All right. Now
we love our vets.
We do. And from a lender's standpoint, this just got a whole lot easier than what we just talked about.
Really?
Okay. So
the government got something easier?
The VA made it easier once they're on the list. Okay.
Okay.
The VA, there's an asterisk.
Easier asterisk.
The VA a condo association has to apply to the VA to get on an approved VA condo list. Once they're on it, we're good.
Okay.
It's not like the FHA has a list as well. And then we still do the questionnaire. With the VA, they've checked it out. The VA says you're good, do the loan. So not as intensive. But the association has to get approved. And we're going to talk in a minute. I put in our notes. We're going to talk about how we could, as lenders, can help them with that.
At a high level, can you explain or just give us a nugget on the asterisk part? Like, how do they get on the list?
They get on the list by submitting to the VA bylaws, articles, budgets. Trying to remember when I did one. Plat maps. A bunch of information about the financial situation and the phase completes to the VA, there's a questionnaire that the VA wants to get the full complex approved.
Now, most board members at a condo association aren't going to be savvy in this. So if you're a real estate agent, feel free to, no strings attached. I'm not trying to get loans or anything like that. Feel free to reach out to Richie or I. We will coach you or send you to the right websites to have the association get this project VA approved. The whole goal is we want to help our veterans own the land they defend. Yeah. So our objective here is a rising tide lifts all boats. We are here to serve. Richie's an expert in this topic. I've been doing this for 30 years. Please, if you have an association that you want to get approved and you're not sure how to do it, just reach out to Richie or myself and we'll walk you through it. No strings attached. Okay.
So for simplicity, if you're the listing agent, you want to know if you can accept a VA loan, it's public website. Just go on the internet and search VA approved condo list. The website comes up, you fill in a couple boxes of where the thing's located. It asks a lot of detail about like condo association name. I say don't do that. I keep it very generic. I just put in Waukesha County and I see all the condos, because what if I misspell the name and it doesn't come up?
Less is more.
I put in Waukesha County and then I just click through. It's alphabetical. I click through and find the association. Oh, there it is. It's on the list.
Yeah.
So that's what you can do as a listing agent or buyer agent. It's a public website.
Yes. Great. Okay. What about it's not on the list? And I really don't care about the whole, if I'm a real estate, I don't care about the whole project. I'm just trying to get my veteran into this specific condo because they're downsizing and that's where they want to live because it's close to the grandkids.
Yep.
What do I do, Richie?
Two options. There is a VA single condo unit approval process.
Okay.
If the condo association had gotten denied for the full approval.
Okay.
They have to have tried to get the whole association approved. If it got denied, now the VA will consider it for a single.
Okay.
Okay. The other thing is, I'm helping a veteran right now. We're just doing a conventional loan.
Okay.
It's just, you don't have to use the VA loan. And veterans, they get a big benefit and all that stuff.
Yes.
But at the end of the day, they could use a different loan type. That could be possible. They may lose the no down payment VA loan.
Yeah.
Maybe a lender can help them with down payment assistance or something. But make sure that if you have a veteran and they want a condo, I'd be asking the lender, have you pre-approved it for other loan types?
Okay. What about when it comes to the association, if they want to get it VA approved, is there a fee that the VA charges them for that?
The VA does not charge a fee. However, a lender like us, a mortgage lender, is the one who has to apply. Okay. Or same when we talk in the FHA, we can, as a lender, we can do that for the association. There's no fee. Now there are companies out there that association can hire to do it for them. Okay, that's allowed. But the last I read the rules, the association cannot apply directly on their own.
So if you have a veteran out there, please just contact us and we will help you.
Yep.
Okay, bottom line. So, all right. So is there anything else about the VA loan and condos that you'd like to share with us before we go to the next one?
Nope, I think that's good.
All right. So a lot of people don't really understand the USDA, the United States Department of Agriculture. All right. So the USDA actually is a very not well-known loan product. All right. So we do USDA loans here at our company. Right. Not everybody does do them. It is got some nuances to it, and there's some beauty behind it as well. It's more geographically restricted, but it's not what you think. It's not in the middle of a cornfield.
No.
All right. So Richie, talk to us a little bit about the USDA loans.
It'll sound the simplest because it has lots of options. All the USDA,
I like options.
yes, all the USDA asks is to make sure the association meets the standards of a conventional loan, FHA loan, or VA loan.
One of the three.
One of the three.
Not all three.
No. So, for instance, if the condo association is on the VA approved condo list, you can do the USDA loan there. If the condo association is approved by the FHA on their list, you can do a USDA loan there.
Okay.
If the association can pass the condo questionnaire of a conventional loan, you can do the USDA loan.
Well, if I'm a real estate agent, I'm thinking, why are we just doing USDA loans on these condos? What's some of the restrictions on the USDA loan?
Geographic.
Geographic's a big one.
The USDA's goal by offering loan types is to help with less densely populated areas.
Okay. How do I find out? Because I think there's a misnomer on what that looks like.
Yep.
Is there a website? Is there somewhere out there that can tell me if this property is located in a USDA approved territory? Because my understanding is, and correct me if I'm wrong, you can have the same zip code, but on one side of the street it's not USDA, and the same zip code on the other side of the street is. Is that true?
That is true.
Okay, so how do I know as a real estate agent what I'm dealing with here?
So just search USDA. Oh my, now I forgot what I had to.
But there's a website.
There's a website,
Yeah.
USDA geographic approval area. Okay, a website's going to come up. If you can't find it, send us get a hold of your loan officer. They know what it is. And you can just type in any address. Like if I want to know a certain area, I just type in one of our office addresses, and a map comes up, and they got 2 colors on the map. And I just scroll around and go, okay, where do we got to be?
Got it. Okay.
So it can be in cities. We don't ever want to give the impression you can't be in a city, like for Madison, the city of Madison, Monona, Verona, Middleton are not eligible, but Cottage Grove is, Windsor is, Cross Plains is, so you can be in those cities.
It's like Oconomowoc. Some Oconomowoc is, some Oconomowoc is not. So
yes,
you just don't know. You got to really look at the map. So, Richie, one more question on the USDA loan.
Yes.
How big is the minimum down payment on a USDA loan?
0 down payment.
That's a
30-year
pretty good
loan.
alternative, right?
Yep.
No money down. And are they competitive with their private mortgage insurance?
It is. Mortgage insurance on a USDA loan is not based on credit. It is a percentage, and it is 0.35%. That is very low.
Yeah, that's probably the lowest, other than maybe like an 800 credit score, 81% loan to value or something.
Right. Yeah.
Very, very cheap. So USDA loan is an unknown great loan product to always consider. If your loan officer's not savvy in that, have them reach out to us. I will educate them, no charge, not trying to steal, just trying to help everybody. So, all right. So, Richie, you've been with ProVisor for a long time. You've been top 2 loan officers for many years. All right. And so what does ProVisor, when you work with your clients, talk to me a little bit like how you approach the condo and the association, the approvals and stuff like that. How do you handle it?
So
Just as a veteran, not a Army veteran, but a veteran, long-term tenured,
Yep.
experienced super smart loan officer. Just share with us, some of us who maybe are a little bit newer in the industry. How do you do it?
So you pre-approve the person, you make the condo, you make the property type condo, right? And the risk software run, it all works. Now I try to educate when we know that there's a person wants to buy a condo. I try to educate the buyer agent, say, hey, when you find the condo, here's the top questions you should ask of the listing agent or the association. I'll call the association, and because it just makes sense to understand what's going on before they make an offer.
Okay.
And if a loan officer is not doing that, then they're not doing their due diligence, not helping their customer, the borrower, not helping their customer, the real estate agent, of making sure the agent understands what are our potential hurdles before we get it.
There's a lot of good loan officers out there, but they may not understand the intricacies and the complexities behind the condo loan, because there's a lot of layers in a condo loan. So once again, my name is James Mercado. I'm with Richie Bauman. We're with Ask ProVisor. We're down to 3 more questions or 3 more points that we'd like to bring. Okay. So what I want to talk about is there's this big rise on people buying duplexes and converting them into condos, or buying a 4-unit, converting that into condos. Feel free to speak to that, because you have a lot of investors that say, hey, if I buy this duplex and I turn it into condos, it's worth a whole lot more money.
It is.
Talk to that, Richie.
So a loan can be done. Conventional, it's kind of going to be the same thing. So you can't have the person, like, let's take a duplex. The person can't own both sides.
Okay.
That's doesn't meet the some of the standards, right? FHA loan, there's an extra rule. All that stuff I talked about, there's one extra rule when it's about it, is that the association has to be 5 or more units. When we get 4 or less units in the association, now we have to apply to get the whole association approved.
Okay.
We can't do this single unit thing.
So you can still do a duplex or 3 triplex or 4plex, but there's no spot approval.
No.
Not single, but you have to have the whole thing
association
done.
Yep.
Okay. It's good to know, everybody.
And
Less than 5 units, whole association, no spot approvals.
but the biggest hurdle I've seen when people have found these 2, 3, or 4 unit associations, really the 2 unit, and that is the master liability policy.
It's always a mess.
So the bylaws dictate whether association has to have a master liability policy. The person who originally created this into a condo association, and they filed the bylaws at the state of Wisconsin, they had to dictate in there whether a master liability policy had to be in place or not. Sometimes they don't. Like the bylaw says it doesn't. So now each individual homeowner of each unit, the 2 units, they have to have a policy that covers not only their drywall in, but the whole building and the whole property, so that they are personally protected in problems with the house.
So let's take this. There's a duplex. We turn into condos. You own a condo and I own a condo. We're neighbors. Okay. So in case you're irresponsible, I have to have my contents policy, but I also have to insure the whole building, including your side.
Yes.
And you have to insure the whole building, including my side, if there's no master policy.
Yes.
Just in case one of us don't pay the premium or whatever, because if your side burns down, it affects my life.
It does.
Got it.
So the options when it's a duplex or 2, 3, or 4 is either each individual owner has a policy for the whole property, just like they would have for a house.
Yep.
Or there's a master liability.
So they could amend that bylaws to do that.
Yeah.
Because what we're finding is people say, well, he pays his side, I pay my side, and
Right.
he does his stuff and I do my stuff, and it's worked out for 15 years. What's the problem? Find a new lender.
What happens in those smaller associations,
Yeah.
they don't have board meetings.
Nope.
They don't have meeting notes.
Nope.
They just live life, each splitting some money. But the bylaws start to dictate what to do. I had an association, 2 units. That's what they were doing. They each just had a policy, and the bylaws came in. We had to say, I'm sorry, you guys got to get a master policy. That is in what's in the law for your bylaws that you filed in the state of Wisconsin.
Just because they've been doing it that way for 20 years, don't matter.
Doesn't matter.
Right. Okay.
So yeah, that's what's in small and smaller units. Still possible.
Still possible. All right. All right. Here's the big word. If you're falling asleep, wake up. We're going to talk about non-warrantable definition versus warrantable. Richie, the expert, is going to share with us because this comes up every single day. Is it a warrantable? Most loan officers don't even know what the difference is.
Yeah.
So you're going to be, if your loan officer doesn't know, educate them or find a new loan officer.
So warrantable means that the condo association will meet the conventional Fannie Mae, conventional Freddie Mac, FHA, USDA, or VA loan types. That is a warrantable condo. How they pick the name warrantable, that I don't know. Never looked it up. Okay. If they don't fit one of the 5 traditional loan types, your condo association now gets labeled non-warrantable. Doesn't mean a loan can't be done. It just means those 5 loan types cannot be used. And so now non-warrantable, if you're familiar with like the term portfolio loan is when a lender, they're not using the traditional, they can make up their own rules. They're 100% exposed. They have no insurance.
Typically, those loans, though, are only locked for 3, 5, or 7 years.
Right.
Rarely 10, but that money's locked. It's like a balloon loan where then they got to renew that at the end of the term. So it's not a traditional 30-year fixed rate mortgage.
Yeah.
It's amortized for 30 years, but it's only locked in for 3, 5, or 7, usually is what we see.
Yeah. So now if your condo doesn't meet the traditional, the condo association gets labeled non-warrantable.
Okay.
Loans can be done, but it is a loan that doesn't have any of the insurance from the other main loan types. And every lender can make their own rules of what they will do in a non-warrantable
So
situation.
they may say, we're not doing this unless you put 20% down.
They say that.
Okay.
They may say it's 10. They may say, oh, every unit has to be owner occupied, or we don't care how many units are owner occupied. Like it's all over the board. So now if a buyer wants a condo in a non-warrantable and they go to, let's just say, a bank, that bank has their rules. If the borrower gets told no on the non-warrantable, they feel like they can stop. But if they're at a broker situation, we shop around to a bunch of different places for non-warrantable situations because everyone has their different rule types.
Okay, it's kind of the wild, wild west when you have a non-warrantable situation. It's not a hard money loan, but it's kind of like a hard money loan where it's like, hey, it's my money. We're not selling it on the secondary market. And since it's my money, I get to make my rules as long as I'm not discriminating against, religion, sex, race, things of that nature, which obviously are obvious.
Yeah.
But as long as the rules apply to everybody, whether you're a green person, a yellow person, or a purple person, it doesn't matter.
And if you want to know if the condo association is warrantable or not, again, just go back to the stuff we just talked about, conventional and FHA loans. Ask those questions. And if you're getting the wrong answers, you have a non-warrantable situation.
Correct. Okay. All right. Last point today. New condo projects. Enlighten us.
You're in a non-warrantable situation. Okay. Think about it. And again, it's that half house analogy I did before.
Yeah.
It's new. It's not complete. There's places that may get you a loan because obviously loans get done there, but you need to know in the situation that it's a new condo project and you got to know whether or not you can do the Fannie or Freddie so that when you get offers on those, or you're talking to, like, let's say you're a real estate agent and you want to go out and be the exclusive agent for the whole new development. You want to know where they're at with these questions so you know that you set up relationships with lenders that can do loans in a new condo project so that you can be the expert resource for people who come and make offers because the buyer agent is probably not going to do, I would assume, not going to do the due diligence of knowing what's going on in that association. So that's why we tell you as a listing agent, get ready when you want to rep a new condo project.
So just to be clear, statistically and historically, non-warrantable projects usually have a little bit of a higher interest rate attached to them as well. So there's more risk involved. The specific lender calculates that risk. They figure what it's going to take for them to be able to lend on that. So there's usually, I'm not talking, 20% interest rate, but usually there's a little bit of a surcharge built in there because of the risk on the non-warrantable.
And with the new condo project, let's go back to the phasing thing. If you go to a new condo association and you see one building is complete, ask the developer, is this the phase complete? Because if that phase is complete, you don't have a new condo project for the condos in that phase. Now you can do the traditional loan types. So that's part of the new condo.
So he may have a building done, but phase one could have 3 buildings in it, but only one of the 3 buildings is done.
That would be a
So
problem.
the building's done, but the phase is not done.
Yes.
You might have 3 phases, which could be 9 buildings.
Right.
But phase 1 is not done because he's only got 1 or 2 of the buildings done.
Yeah.
Very important to
Yeah.
know. Yes. Interesting information. This is a lot, everybody. So it's a complicated business. If it was easy, everybody would be doing it. So I just want to encourage you to be a student of the business. You know, I always tell people the more you learn, the more you earn, you know, because if you know more than the next guy, you're going to be able to close more deals. So this has been really valuable.
And I put together a checklist,
Mhm.
a yes, no question checklist, which all our loan officers will have.
Mhm.
And if you work with other lenders, you're going to want to ask them to put this together for you. So it's a 1 page that realtors can have.
Like a cheat sheet.
It's a cheat sheet where you just ask these questions and it tells you what's the proper answer, yes or no. And now you, in like 5 minutes, can have the condo association just fill out this questionnaire and you're going to have a lot of these answers. So every loan officer provider will have that, and just let us know if you want that copy.
All right, we just got a live question that I want to share with you guys, all right? This real estate agent just said, listen, my borrower is an 800 credit score, 800. They got 30% down, and it's a brand new condo project, but they want to do a 30-year fixed rate. It doesn't matter what their credit score is or how much they have down.
No.
It's still non-warrantable.
It's about the condo association. It's not about the borrower.
It's not about the borrower. And a lot of times real estate agents and borrowers like, that's offensive to me. I have perfect credit. I could pay cash for this thing if I wanted to. We don't make the rules. We just have to follow the rules. And the rules are the same for all the lenders. In a warrantable situation, in a non-warrantable situation, it's the Wild West, to be honest with you.
Yeah.
So, all right. Great question. So thank you for asking. All right. This is Ask ProVisor. We're trying to help educate real estate professionals. Next month, we are talking about
Renovation loans.
everybody loves them and some people hate them.
They're a great product because now you can, in this market, my perception as a lender, in this market, everybody's got to run to this house right away and get it, or there's not enough inventory. I have not looked it up because I don't have access to the MLS, but I'm wondering, are there houses that have been sitting out there 30, 60 or more days that nobody's making an offer on because there's a problem?
Yes.
Mold in the house or I got one right now. The house was never completed. The person was remodeling, he just stopped and all you see is studs. A renovation loan is where a borrower can borrow more money than they're paying for the house for a contractor to complete the work.
Got it.
So we'll talk in detail about that.
And there's different loan types for that as well. All the different loan types for this, there's renovation loans in all those spaces as well. Once again, thank you for tuning in today. This is Ask ProVisor. My name is James Mercado, and this is Richie Bauman. Appreciate you taking time out of your day to educate yourself and empower yourself to make good decisions when you're out in the field helping clients to get more deals. Thank you, guys.